Today, folks, we're uncovering the historic run of the greatest Canadian dividend stock of the last 5 years and is now the fourth largest company in Canada. And you in my chat group cannot shut up about this company. You said, hey, Kyle, you got to make a video on this. And if you want to join those discussions, go hit up the Patreon link down below and you can join myself along with other 6 and 7 figure investors where we chat about this stuff way too much. But let's break this down first and foremost by what are the largest companies in Canada. As it stands today, Royal Bank at numero uno here, sitting at a whopping $160 billion market cap. And these are crazy yields right now on these companies. 4.7%. Toronto Dominion Bank sitting at 4.8% with a $144 billion market cap. Third in line as of only basically today since the recent run of its earnings, of course, Shopify at $105 billion. And just before today, what would have been the third largest company in Canada would have been Canadian Natural Resources. And this company really didn't do much since the early 2000s, leading all the way up to the pandemic. Basically, when their capital gain, their stock price dropped off so dramatically by 70%, only to see the most historic recovery of any Canadian dividend stock ever, rallying up 600+% and increasing its dividend beyond anybody's wildest imaginations. And a few of you in our chat group actually were able to pick this up during some of those pandemic lows. So currently it's trading for around a 13 PE, $101 billion market cap, and about a 3.8% dividend yield. And this is a huge, I think it's the second largest natural gas producer in Canada, and it is a huge oil giant here now in Canada. We're going to break down what has caused this run. Why is the stock still running even year to date up 30%? And is it worth buying? I'm going to give you my honest opinion here. And if it's conversation you'd appreciate, as always, hit that like button, as this is a company I have direct exposure to just through buying my VDY ETF, which is the monthly paying Vanguard Canadian Dividend ETF. But first and foremost, looking at those revenues, the company is seeing a decline in revenue ever since the peak of basically coming out of the pandemic, the big oil rush and WTIs. It's kind of been suppressing. We're seeing that directly reflect into the revenue prices along with the EPS. And you can see how the earnings per share definitely reflected the stock price before the inevitable pullback that came with the oil kind of reduction in that value. So it's kind of neat that the stock actually isn't pulling back with the recent pullback because it's pretty dramatic. I mean, you can take a look at the earnings per share has dropped off quite a bit, which we'll see when we get into the earnings. The dividend, I think, and this is going to be the conversation that will persist, I think, in what's keeping the stock so valued, is the wicked increase. So from 2020, the dividend was 38 cents. They paid a special dividend in 2022 of a crazy $1.50, but today you're getting around 90 cents from 38 cents. So over a doubling of the dividend just within a few years, which is just bonkers, and over 20% Geiger growth on that dividend. And if you go back 10 years ago from 13 cents to 90 is just absolutely mind-boggling realistically, right? So let's talk about the company itself, because currently they've got about 60% reserves, which are high value, like crude oil and NGLs, with 32-year total proved reserve life index. The company's got a long runway ahead of it with its current, resource estimates. And you can see here that it's kind of intriguing too that natural gas right now is starting to recover a little bit, but I'm surprised after the wicked price crash in natural gas that this didn't see the same kind of hit, because again, this is basically the largest natural gas reserve in Canada, which is kind of, again, jaw-dropping, right? And just taking a deeper look into this, we can see that this company basically, if you take a look at their production mix, 27% natural gas, 29% heavy crude, light oil and NGLs sit at about 10%, and SCOs sit at about 34%, with some pretty good exposure here, but again, most of it being in North America, specifically Canada. And you can take a look at where I think all the value is currently being derived for this company, because Canada is a dividend-focused economy. People here love their dividends, and in this expensive world, we're using this as part of our retirement funds. So it's no surprise that their dividend growth has been just absolutely bonkers. They increased the dividend twice by 45% and paid a special dividend for a combined total of $4.9 billion. They've been doing a share purchase of $5.6 billion, and again, this is just the long-term value they've been deriving since 2022. They've been leading free cash flow generation around $11 billion after the dividend, and have about a 4% production growth, basically low maintenance capital and disciplined capital program. So let's break this down a little bit farther here. If we take a look at the Geiger, as mentioned, you're talking about a 21% since inception. I don't think they're going to be able to personally sustain this. I think this is just something that came into fruition over the explosive, explosive lead in oil and natural gas that came through the pandemic, and plus probably some pretty major discoveries they've made that have led to some pretty explosive production for them. But this has been 23 years of consecutive dividend increases. I can imagine they'll keep trying to increase the dividend. They've got room for it as we take a look at the actual balance sheet here. With first and foremost, let's talk about the assets and liabilities. Now, before we look at the assets and liabilities, I should also point out that they did increase the dividend just on this last payout by an 11% increase, which is absolutely bonkers. This company continues to excel, and they've got a lot of room to continue to grow this dividend, but it is not against the best backdrop. As we take a look at these earnings, I'll kind of show you what I'm talking about. But first and foremost, total assets at $76 billion versus total liabilities of about $36.6 billion is very healthy against most infrastructure-based companies, so very controllable. If we take a look at the cash, they've got about $125 million in cash with accounts receivable of about $4.2 billion against basically their total current assets of $7.5 billion and the total liability or total current liability of $8.25 million. So it looks like their asset liability standpoint is fairly healthy overall. But where I become concerned, and again, I'm not trying to be overly bearish, I think the company's still in a very healthy position, but you've got to recognize that there has been a correction in gas and oil and all these commodities, and we're seeing that directly reflected on the revenues. Let's zoom in so you can see this nice and clear on the 9-month ending, going from basically $32.6 billion in revenue, again apparently this is less royalties, to $26.4 billion in revenue. Is a pretty big decline on the year over year. It's relatively flat, going from $10.4 billion to $9.8 billion. And if we scroll down, we can see that there are some depreciation and amortization costs, which does not reflect into net earnings. So the net earnings might be a bit higher if it wasn't for that, but still we're seeing a pretty rapid decline. If we take a look at the 9-month ending, going from $8.23, basic EPS to $5.12, that is a huge drop. And even on the year over year here, going from 252 to 215, to not see the stock price drop on this means there's a reason that investors are buying, and I think it's largely related to this dividend payout. And if we actually take a look, this is based on the 9-month ending here, we can see they paid about $2.95 billion in dividends, which their payout ratio is under 50% as it stands in this moment, but it is declining over the 9-month per last year. And I think I don't know if that includes the special dividend or not, but that special dividend came out of nowhere. My God, was that was juicy for shareholders. But all in all, we can see their stock-based purchases slowing down from 4.2 billion to 1.5 billion. They are slowing down on quite a few metrics here, but I still think this could be one of the most resilient stocks leading into the future. You just have to understand that I don't think the stock deserves to rally off these basic earnings unless I'm missing something. I think a lot of people are getting very hyped up just because of the insane dividend growth, and that's what Canadians are chasing as we head into retirement. It's something that we all desperately need, and this company has been proving to literally be the best dividend company of the last 5 years. It's just a matter, I don't think it's going to be the best dividend company the next 5 years, because it's all highly dependent on what crude oil prices have done. And we can see coming out of the pandemic, it basically fully followed the crude price, but it didn't follow it back to the downside. And same again when we were looking at like natural gas prices, right? Natural gas is nowhere near those highs, but again, as natural gas becomes a huge proponent to our future, as it's one of the more renewable oils and energy producers, it's likely the price is going to stay at elevated levels, which it seems to be even right now. If we look back over the last 10 years, it's definitely above the historical averages. But yeah, this is going to follow the stock, and the earnings will largely follow what oil and energy does. And because it's been already reduced, I wouldn't expect too much more upside in the stock price personally. But again, I still like the company. I still think there's potential in the future. But if I made those huge gains on it that we've seen basically just over the last 3 years, I would definitely probably be taking some profits and diversifying it because there's a lot of other great companies trading at discounts like Enbridge, a lot of the other oil and natural gas companies. But I obviously get exposure through cost averaging just through VDY, the monthly paying dividend ETF, which I think is a great way of doing it. But yeah, what an incredible story and an incredible company overall. And I'll pass the question off to you as we head into what could potentially be a recovery in the Canadian and broader markets, as we saw a massive bump up in the banks today. I mean, let's just take a look at TD here over the last days, up 2.6%. TELUS jumped up 4%, and we're going to get earnings from Enbridge and TELUS tomorrow. Lots to uncover this week. And if that's a story you'd appreciate, consider hitting that like button and subscribing for those updates. But let me know what you think in that comment section below.